Something is deeply broken. The old rules don't apply anymore. Fundamentals feel irrelevant, data feels fake, and every time markets start to stabilize, a political shock resets the board. This isn't paranoia. This is what an uninvestable regime looks like. The people closest to power know what's coming. Everyone else finds out after the prices move. And right now, the model I track just hit 67 out of 100 on the recession risk scale, pre-recession phase. While markets sit near all-time highs, I've been tracking the system for 3 years now. It's never been this disconnected from market sentiment. That gap, that's where fortunes get lost and made. What's up, guys? It's Tom here. If you've been following this channel, you know we've been ahead of this cycle. We called Bitcoin's crash before it dropped over a third from its peak. Back in December, I showed you the momentum indicators screaming caution while crypto Twitter was calling for six-figure Bitcoin. We flagged the jobs overcount months before the government admitted they were off by 800,000. I literally pulled up the birth-death model adjustments that were inflating numbers artificially. The safe portfolio I track has quietly beaten the S&P by over 3% while taking less risk. Cash, treasuries, defensive plays, boring stuff that actually worked. And the recession model? It's been climbing steadily for months. Started the year at 51, hit 62 in February. Now it's at 67, up 3 points just this week. The algorithm is seeing patterns in the data that sentiment surveys are missing. And I think we need to talk about what that actually means for regular people trying to invest right now. Because here's the thing nobody wants to admit. This isn't a normal investment cycle. This is policy roulette. Markets aren't responding to earnings or growth or innovation anymore. They're responding to executive decisions. Tariffs, sanctions, military actions, regulatory threats, all of which can arrive without warning. A company can beat earnings, guide higher, and still sell off hard because some policy memo invalidates the entire business model overnight. Tech stocks are the perfect example. You're told to buy quality Apple, Nvidia, Microsoft. These are incredible companies with dominant market positions and strong balance sheets. But quality doesn't protect you when a surprise tariff reprices input costs in one day. Apple gets 20% of revenue from China. One trade tweet and that entire revenue stream is at risk. Nvidia builds chips in Taiwan. Any escalation in that region and supply chains collapse overnight. Microsoft sells cloud services globally. Export controls can shut down entire markets with the stroke of a pen. Or when retaliatory trade actions hit revenue abroad. This isn't normal volatility, this is policy whiplash. And if you don't know which country or sector gets targeted next, you can't hedge it. It's like playing poker when someone can change the rules mid-hand. Traditional portfolio theory breaks down when the government becomes the primary source of market risk. Now here's where it gets interesting. The people who are making money right now aren't smarter than you. They're closer to the information. This isn't about secret cabals or conspiracy theories. It's simpler than that and more frustrating. People close to policy hear about tariffs before they're announced. They understand enforcement timelines. They know which agencies are getting more funding and which ones are getting gutted. They anticipate regulatory shifts. They position capital accordingly. I'm talking about former government officials who join hedge funds, lobbyists who understand legislative priorities, corporate executives who get advance notice through industry associations. These aren't evil people. They're just playing with better information. Large institutions hedge this with option structures, geographic diversification, political intelligence services. Goldman Sachs pays millions for political risk analysis. They have former Treasury officials on staff. They model policy scenarios 3 steps ahead. Meanwhile, you're reading the same headlines everyone else gets after decisions are made. You react after the move. That's not your fault. That's the structure. Information arrives unevenly. And in this cycle, information is the asset that matters most. And it's getting worse because you can't even trust the data anymore. Right now, the model is seeing barely any jobs being created. Stall speed. When you strip out the birth-death adjustments, seasonal fudging, and government hiring, private sector job creation is basically zero. The labor market is falling apart underneath the surface, but headline numbers stay elevated just long enough to keep everyone complacent. Last month's jobs report showed 180,000 new jobs. Sounds decent, right? But 150,000 of those were government positions or statistical adjustments. Real private sector hiring was maybe 30,000. That's recession territory. GDP data gets revised constantly. First quarter growth gets reported at 2.1%. 3 months later, it's revised down to 1.4%. By then, everyone's moved on to the next quarter. Tariffs inflate activity numbers without improving real productivity. A company imports twice as much inventory before tariffs hit. That shows up as increased economic activity, but it's just timing shifts, not real growth. Government shutdowns create missing data windows. The BLS can't collect statistics. If agencies are closed till they estimate, then they revise. Then they revise the revisions. The result is an economy that looks stronger on paper than it feels in reality. Consumers feel pressure. Credit card balances at record highs. Savings rates falling. Small businesses feel pressure. Commercial loan delinquencies climbing. But the numbers say everything's fine. That's dangerous because when recessions finally show up in official data, they're already 6 months underway. So what do most people do? They retreat to cash, treasury bills, money market funds. Makes sense, right? Rates are higher than they were in the 2010s. You can get 4.5% risk-free. Volatility is elevated. Recession risk is real. Better to be safe. But this creates a brutal trade-off. If you sit in cash, you miss equity upside during relief rallies. Markets can still rip 10% higher on good news or policy reversals. You miss innovation cycles. AI companies can still double while the rest of the economy struggles. You fall behind if tariffs and fiscal spending push inflation higher. That 4.5% yield becomes negative real return if inflation hits 6%. If you move back into risk assets too early, you get punished for optimism. Every time markets look stable, another shoe drops, another tariff, another geopolitical flare-up. Another data revision. You buy the dip and the dip keeps dipping. You're trapped between missing gains and absorbing sudden losses. That's why this cycle feels impossible. Every choice has hidden costs. Conservative investors get crushed by inflation. Aggressive investors get crushed by volatility. Moderate investors get crushed by timing. And here's the part that really stings. Modern markets are dominated by participants who don't care about your growth narratives or investment thesis. Algorithms, high-frequency traders, quantitative hedge funds. They don't read annual reports. They care about volatility, correlation breakdowns, event-driven pricing, momentum shifts. These players thrive in chaos. They scalp dislocations. They hedge instantly across multiple asset classes. They don't get emotionally attached to positions. They don't care if Apple is a good company. They care if Apple's options are mispriced relative to implied volatility. Meanwhile, long-term investors are told to ignore the noise, stay the course, focus on fundamentals. But when the noise is the signal, that advice becomes dangerous. The VIX has been spiking hard lately. Fear gauge hitting levels we haven't seen since 2020. Market fear is elevated and sustained. Oil is creeping higher. Brent crude pushing toward $85 as supply chains get disrupted. People are worried and pulling back spending. Restaurant traffic down. Retail foot traffic weak. Consumer confidence surveys showing real pessimism. The model sees all of it in real time. 29 different indicators feeding into one composite score. Regular investors, they find out when CNBC reports it 3 days later after the institutional money has already moved. So let me walk you through how this plays out. There are really three paths from here, and I want to be specific about probabilities. Path 1, soft landing. Inflation cools without recession. The Fed cuts rates carefully. Tariffs stay targeted and don't escalate. Geopolitical tensions ease through diplomacy. Markets rally as uncertainty fades. The model score drops back below 60. Everyone exhales. Goldilocks scenario. That's the best case. I'd put that at maybe 25% probability right now. Path 2, grinding slowdown, jobs stay weak, consumer spending drops gradually, earnings disappoint but not catastrophically, but it's slow enough that policy can respond. Recession but managed, think 2001 rather than 2008. The model hits 75, markets correct 15% to 20%, then stabilizes, Fed cuts aggressively. Unemployment rises but stays below 6%. Housing wobbles but doesn't crash. That's the likely case. Maybe 50% probability. Companies that survive actually get stronger as weak competitors fail. Path 3 is the one everyone's terrified about, but nobody wants to discuss. Geopolitical shock, oil spikes above $100, inflation reignites. Fed can't cut because prices are rising, economy stalls anyway. Think stagflation. The model goes to 85 or higher. Full recession mode with persistent inflation, markets crash 30% or more. Credit markets freeze. Housing collapses in expensive coastal cities. Unemployment hits 8%. That's 25% probability. But the impact is devastating, and in that scenario, the people who saw it coming and positioned defensively do fine. Everyone else gets wiped out for the second time in 6 years. So what does this actually mean for you? If you're fully invested in index funds right now, you're making a bet that this stays contained. Maybe it does. The S&P could grind higher for months, but the risk-reward is asymmetric. If nothing bad happens, you gain maybe 8% to 12% this year. If things go sideways, you lose 20% in a month and spend 2 years getting back to even. That's not attractive math. If you're carrying debt, credit card rates, auto loans, mortgages, you're paying high interest rates while the job market weakens underneath you. That's brutal. Your cost of capital is fixed while your income becomes uncertain. If you're saving for a house, affordability is still terrible, even with recent price corrections. Now recession risk is climbing, which means your job security could deteriorate before prices fall enough to matter. There's no easy answer here. That's the point. This cycle is designed to be hard for regular people. Policy uncertainty benefits those with the most resources and flexibility while punishing savers and workers. And look, none of this is fair. You're trying to save for retirement, maybe pay off student loans, maybe buy a house, maybe just build some financial security for your family. You're doing everything right, dollar cost averaging, diversified portfolios, emergency fund. But the game changed and nobody told you the playbook from the 2010s doesn't work when politics drives markets more than profits. That's real. Charts and models don't fix the fundamental unfairness of this situation. Bottom line, the recession model sits at 67 out of 100. Pre-recession phase. Market fear is spiking with VIX elevated. The labor market is stalling when you look past the headlines. Policy uncertainty is through the roof with every tweet potentially moving markets. And the people with the best information are positioned accordingly while everyone else reacts to headlines. I remain defensive. 40% cash in short-term treasuries, 30% defensive equities like utilities and consumer staples, 20% international developed markets for dollar hedge, 10% commodities and real assets, same posture I've held since late 2025, and it's outperformed while reducing volatility. The model's 18-month forecast is showing the grinding slowdown scenario as most likely right now. Not a crash, but not a soft landing either. Somewhere in between. If you want to track this stuff in real time instead of waiting for my weekly videos, I built a full dashboard at recessionistpro.com. 29 indicators updated daily, 18-month forecast model, scenario analysis, $20 a month. No long-term commitment. Here's what I'm watching next. The model needs to stay above 65 for 3 consecutive weeks to confirm we're locked in pre-recession mode. We're in week 1 right now. If jobs data stays weak and the VIX stays elevated above 25, we'll hit that threshold by month end. Second thing to watch is the Fed meeting this month. If they cut rates 25 basis points while the model shows recession risk climbing, that's confirmation they see what we see. They're getting ahead of something. Third, watch credit spreads. High-yield bonds are starting to underperform treasuries. That's usually 6 months ahead of equity markets. If this analysis gave you something the financial news didn't, something more specific than markets are volatile, hit subscribe. We're tracking something important here.